Well, good morning, everyone. Thank you very much for taking the time to be with us today for the latest Sygnia webinar on our superhero funds, 7 essential funds to help you ride out the Corona coaster. My name is Ian Anderson. I'm co-head of investments at Sygnia. And if you've been listening to our webinars, you would have heard me speaking a number of times about our portfolio construction, our strategies for a low return, low growth environment. And you would have heard my colleague, Kyle Hewlett, also co-head of investment, speaking about our portfolio positioning and how we're trying to take advantage of this highly volatile environment. So this morning, we've got something slightly different. You're going to meet different members of the team. Each of them is going to be speaking about a different fund within our portfolios. And I will touch on this, but we very much construct our portfolios on a core satellite approach. So we're going to be focusing on the satellites within our portfolio this morning. So there's a tremendous amount to get through. So we're going to try and be as brief as we can. And if you do have questions, I'm sure there'll be a lot of questions, please type them in. And we probably won't have time at the end of the presentation to address them all, but we will certainly get to them all and email you back. We will have your details. So very quickly this morning, Eva is going to be speaking to us about the Fourth Industrial Revolution Fund, a very exciting fund that we've got at Sygnia. Tanya Pavlo, our head of credit, she's going to be speaking to us about the OSI fund, the Oxford Sciences Innovation Fund that we've got. Stephen Empedocles, he'll be speaking about the Enhanced Bond Fund, a very important fund given the amount of interest rate cuts and the substantial reduction in interest rates that we've had this year. The Enhanced Bond Fund, incredibly important for investors. Vessel Brunt is going to be speaking to us about the Berkshire Hathaway Fund, the fund that's run by Warren Buffett. Many of you will be familiar with that. He'll go into that in some detail. Anton Swanepoel will then speak about our FAANG fund that invests in the Facebook, Amazons, Netflix, Googles of the world. So a very high octane fund, a very high risk fund, but one that has done extremely well in this volatile environment. So Anton will be digging into that. And then finally, Nikki Davidson will be speaking to us about the Health Innovation Global Equity Fund, the latest fund that we've launched at Sygnia. So a very exciting fund. So quite a bit to get through. I'm going to just give a brief introduction and speak very briefly about our skeleton balance funds. But first off, a quick advert. For those of you not that familiar with Sygnia, we are the second largest multi-management company in South Africa. We have 217 billion in assets under management and administration. We're the second largest provider of ETFs on the JSE, and we're the largest international ETF manager in South Africa. So passive investments, very important to us. And again, I'll touch on that, but we've got 41 billion in passive assets. We're amongst the largest manager of passive assets in South Africa. And finally, we've got 230 staff spread across offices in Cape Town, Durban, Johannesburg, and most recently London. So what are we passionate about Sygnia? And hopefully that will come across in the presentations you listened to this morning. But first and foremost is low fees. We think fees are one of the most critical components of your long-term investment success. And it's the one portion of your investment journey that you can control. So we'll speak a lot about that, very important. And how do we achieve these low fees? Well, it's through passive investing, through index investments. And we very much try and do that in-house where we can. So those international ETFs, we believe we're the only manager in South Africa that actually manages our ETFs domestically ourselves. And that is one of the ways that we help keep fees as low as possible. And then very much what we're going to be speaking about this morning is this idea of having alternative investments or satellites within your portfolio. So these sources of diversified return. And certainly in the environment that we're living through, this volatile environment that's come about from this Corona-led recession, global recession that we're seeing, it's very important to have these satellites within your portfolio. So that is what the team is going to be focusing on this morning. And then very much what we do at Sygnia is about harnessing the volatility to manage risk within the portfolios. So very quickly, and again, I always say apologies if you've seen this slide before, but it's incredibly important to us. And this is the detrimental impact that high fees can have on your long-term investment journey. And it never sounds like a significant portion of your long-term return, 1%, 2% in fees. And that certainly doesn't matter in a high return environment, but when we're in this low return environment right now, if markets are maybe returning 5, 6% if we're lucky, inflation's running at 3.5 to 4%, that's only a 2% real return that you're enjoying. And if you're giving that away in fees, it can have a very big detrimental effect. So I just want to quote from a paper that was produced by National Treasury in 2013 entitled Charges in South African Retirement Funds. And and I'm quoting, "A regular saver who reduces the charges on his or her retirement account from 2.5% of assets each year to 0.5% of assets annually would receive a benefit 60% greater at retirement after 40 years, all else being equal." So you're going to get a retirement benefit that's 60% greater just by reducing your fees by 2%. That is a massive difference when it comes to your retirement. And for someone who's a member of a preservation fund for 30 years, this increases to 80%. So that's someone who puts away a lump sum for 30 years, reduces their fees by 2% per annum. They're going to get a benefit 80% greater at retirement. So without a doubt, fees and costs incredibly important to your long-term investment success. Then within our portfolios, just to touch very briefly on this core satellite approach. So we very much within each asset class, we have a low-cost index core that we manage ourselves, again, to keep fees as low as possible. And then we populate the portfolio with these satellites, investments in these satellites. And this is what gives you access to the diversified sources of return, alternative sources of return. And where it doesn't make sense for us to manage those satellites, we will outsource that to external managers. So you'll hear some of that this morning. But it's very much about harnessing volatility and generating returns in this low return, low growth environment that we're currently living through. And just to touch very briefly then, all this comes together within our skeleton balanced range of unit trusts. This is our global balanced range of unit trusts, very core to what we're doing at Sygnia, that encompasses all of these things that we're going to be talking about. So very much a passive core underlying the entire portfolio. We then have a long-term strategic asset allocation. That's our roadmap to the long-term and meet the long-term investment objective. And then we harness the volatility by doing daily tactical asset allocation. Take risk in the portfolio when we want to take risk, and then take risk out of the portfolio when we don't want to be taking that risk. And it, of course, has exposure to these diversified sources of return, such as the Fourth Industrial Revolution Fund, the Health Innovation Global Equity Fund, and the FAANG funds. And all of this, again, at amongst the lowest fees in the industry at 40 basis points all in. So before I hand over to the team, though, just to take a very quick look, how have these funds performed? We launched them in 2013, so it's almost a 7-year track record, and we're incredibly proud of this range of funds. And the Skeleton Balance 70 Fund, this is our high equity fund in this category, in the ASISA multi-asset high equity category, an incredibly important category. There's upwards of 500 billion in assets. This range of funds is just under 3 billion. So we certainly think that over the next 10 years, this fund range is going to grow into the largest fund range in South Africa. Skeleton Balance 70 Fund is ranked 9th out of 86 funds, most of those actively managed funds at very high fees, 9th out of 86 funds since inception. So we're very proud of that. In the medium equity category, this is our Skeleton Balance 60 Fund. It's ranked 1st out of 53 funds since inception. So again, all at 40 basis points, but producing fantastic return for our investors. And then also a very important category, the low equity category, the Skeleton Balance 40 Fund is ranked 2nd out of 74 funds. So we're incredibly proud of this range. And again, it encompasses all of the satellites that we're going to be speaking about this morning, but very much illustrates our approach to portfolio construction, passive core, keeping fees as low as possible, and then seeking out these diversified sources of return. So with that, I'm going to hand over to Eva. She will kick it off for us. And she's going to be speaking about the Sygnia Fourth Industrial Revolution Fund. So I hope you enjoy it. Thank you very much.
Good morning. The Sygnia Fourth Industrial Revolution Fund is a global equity fund. It's available as both a unit trust or an ETF, and both of these have very low and competitive fees. They track the S&P Kensho New Economies indices, which I will explain a little bit later on, but essentially it captures the drivers of future economic growth. The fund was launched in September 2016. We now have just over 2 billion Rand in assets under management, so it's a very fast-growing fund for us. The performance has been phenomenal, which I will share with you as well. And as much as it's a high-risk fund, because it's a global equity fund, it's also a very well-diversified fund, and I'll talk to that a little bit later on as well. But firstly, what is the Fourth Industrial Revolution? Well, if we look back at the late 1700s, at the first industrial revolution, that's when we saw the workers moving from the fields into factories and the harnessing of water and steam power to mechanize production. Then in the late 1800s, in the second industrial revolution, we saw the harnessing of electric power to create mass production. We saw the creation of the internal combustion engine in the aeroplane. Then the third industrial revolution in the 1960s was when we started using electronics and information technology to automate production. This saw the creation of the PC and the internet, and we can all appreciate today how these technologies have revolutionized our lives. We wouldn't be sitting here today on a Zoom webinar if these technologies were not created. So this has really revolutionized our lives, and it's important to look ahead at the now, at the future, at the fourth industrial revolution, and how that will impact our lives and the economies of the future. But the fourth industrial revolution really is the merging of all of these technologies. It's the merging of the physical, the digital, and the biological worlds. And a good example of this is one of the companies in the Fourth Industrial Revolution Fund. It's a company that has revolutionized the lives of people suffering with diabetes. And essentially, instead of going through the invasive process of having to draw blood and check your glucose levels, people suffering with diabetes can simply insert a chip into their arm, wave their smartphone at it, and have an immediate reading. Now, with all of these technologies also come powerful big data. So not only will these individuals be able to have a look at their glucose reading right now, but they will have some data stored. They can check what their reading was maybe an hour ago or 2 hours ago. And as much as these technologies simplify our lives and they make our lives easier, these technologies can also save lives. And again, using this company as an example, if a person with diabetes is sleeping and their glucose drops to a dangerous level, their smartphone will alert them, wake them up, and they can then take the necessary action. So this is just one example of how one simple technology can change the day-to-day lives of people suffering with diabetes. So what are some of these technologies driving the fourth industrial revolution? Well, it's things such as artificial intelligence, robotics, 3D printing, nanotechnology, biotechnology, and all of these things together are shaping our future. And just to appreciate how quickly the world has changed, if we look back at 2005, and we looked at some of the largest and most valuable companies in the world, it was typically big conglomerate firms, financial services companies, oil and energy companies, and in fact, only one of the largest companies back in 2005 was a technology firm, and that was Microsoft. Fast forward to today, and the 5 largest and most valuable companies in the world are all technology companies. So looking ahead, if we had to look at this graph in the year 2030 or the year 2035, hopefully some of the companies in the Fourth Industrial Revolution Fund will be the largest and most valuable companies in the world, simply because how they have shaped our lives and the new economy. So I mentioned that the Fourth Industrial Revolution Fund tracks the S&P Kensho New Economy Indices. So firstly, who are Kensho? Well, Kensho is a big data analytics firm that was launched in the year 2013. Its main funders were Google Ventures, Goldman Sachs, and CNBC. And essentially what they do is they calculate a revolutionary range of 22 separate subsectors, and the composite of all of those make up the index that we track. Now, there's a few important things. One is the classification of these companies and how the weighting of these indices is created. So if we look at your typical indices, such as the S&P 500 and the JSE All Share Index locally, these are market cap weighted indices, meaning that the largest and most valuable companies hold the largest weighting in those indices. And if you had to invest in those indices, you would have your largest exposure be to those companies, the largest companies in those indices. The way Kensho does is they take a very comprehensive and objective view of what are the companies and the ecosystem surrounding those companies that will be driving that future economic growth. So what you might find is that there's some small companies, a lot of them, you've never heard of, but because of the technologies that they're involved in and the businesses that they currently operate in and the impact that will have on our future, those will still be included in these indices. And Kensho, to do that, they also use very big data. So they use things such as satellite imagery, they use social media posts, news articles, search results, and they take all of this big data to assist them in being able to capture what the future drivers of economic growth are. So let's look at these subsectors. So I mentioned to you that there's 22 separate subsectors, and the composite of those subsectors are the index that our funds track. So I'm not going to go through each one of them, but things such as the space index, for example. The companies in the space index are companies that are involved in space exploration, in the mining of rare earth metals. These are the companies that will make it possible for us to travel into space in the future. 3D printing is another index that's very exciting. So all of the companies in the 3D printing index, they're involved in those technologies. And these are technologies that have really accelerated very, very quickly. When 3D printing was first established, it was very much limited to the printing of small insignificant components. But now some of the companies in this index can even print human tissue. So there's a lot of involvement in that space as well. Clean energy is something else that's very, top of mind. Climate change is something that's on every country's agenda, and looking after our environment is becoming increasingly more important. So the companies in the Clean Energy Index, they own and operate clean energy generating assets. So in each one of these 22 separate subsectors, there's many companies, and then the composite of that is what we invest in. I mentioned to you that it's a very well diversified fund. So if you had to look inside the fund, you'll note that there's over 380 separate companies. And some companies are in more than one index. So if we have to look at Tesla, for example, Tesla forms part of the autonomous vehicles index, the clean energy, the electric vehicles, as well as the clean tech. So one company can be in more than one of the separate indices. What you'll also note is if you look at the second column with the weightings, you'll note that no one company has a very, very large weight in these indices. So all very exciting new technologies, but how have the funds actually performed? Well, I mentioned that the performance has been phenomenal, and you can see that from this chart that I have on the slides. The Sygnia Fourth Industrial Revolution Fund returned 45.7% over the 1 year to 31 August. So this really is a phenomenal return, and this also happened with very low fees. And just as a comparison, if you look at the MSCI World Index that returned just shy of 30%, you can see that the Fourth Industrial Revolution Fund was way ahead of that. Similarly, looking at the 3-year return, the fund returned just shy of 25%, but again, way ahead of the MSCI World Index. And if you look at the separate sub-indices, what you'll see is that some have done better than others. For example, clean tech did phenomenally well last year, returning almost 150%. Autonomous vehicles also did really, really well. But the composite, which is the purple bar that I have highlighted there, that returned just shy of 46% to the 1 year to 31 August. So performance has been phenomenal, fees have been low. So why would you want to invest in this fund besides the performance and the fees that I have mentioned? Well, these new technologies are the future. Their impact on our lives and on corporate and the future economy will be exponential. In addition to that, they also diversify away from your typical and more traditional investments that you may have. And then lastly, there's two types of people that will make money from the Fourth Industrial Revolution. One is the very, very bright inventors, the people that are creating these new ideas, new technologies. But then the second set is ourselves and yourselves as investors and providers of capital. So thank you very much for listening to me. And I will now hand over to Tanya Pavlo, who will take us through the very exciting Sygnia Oxford Sciences Innovation Fund.
Morning, everyone. I'm Tanya, and I'll be talking about the Sygnia Oxford Sciences Innovation Fund. This is an ESG fund that invests in humankind. It deploys its capital to generate socially impactful and sustainable long-term returns, where exceptional performance goes hand in hand with changing lives. It makes the unaffordable and the unachievable possible. The Sygnia OSI Fund provides access to shares in Oxford Sciences Innovation PLC, or OSI, and that is a platform company that owns founder shares in spin-out companies originating from Oxford University. So we refer to those spin-out companies as children. I will be referring to children, OSI children, and there are 80 children at the moment, and there are about 10 to 15 spin-outs that take place each year. Now, the Sygnia OSI Fund was launched in May 2019, and the OSI platform itself was launched in June 2015. Looking at that platform, OSI, the aim behind this was to commercialize IP that emanates from Oxford University. And OSI is entitled to a 50% share of the founder shares that Oxford University has in these spin-outs. The rationale was that while your scientists are brilliant in their fields, their skill set is not necessarily commercial. It's not in business, and that makes sense because they are scientists. So the aim behind this was to bring the best of both worlds together, to put top scientists together with top business people, so that commercially viable structures could be put in place and these children launched into the economy. And what are we excited about when it comes to the University of Oxford? This university is ranked #1 in the world in terms of its research. Not only that, in terms of its medical and science division, it's also ranked first in the world. So it's a top university, something that we're very excited about, and just with where we are in the world at the moment with aging demographics, as well as having to currently live through a pandemic, we think that the medical and sciences area and the healthcare sector is going to get a lot of increased focus from investors and also from governments in terms of grant funding. And that grant funding is non-dilutive capital. Nikki's going to be touching on the healthcare sector when she covers the superhero fund, the Sygnia Health Innovation Fund, and then she'll be going into that in more detail. If we look at that platform company, the OSI company, and what it's been able to achieve since its launch, and this timeline gives a great visual. So as a reminder, it was launched in June 2015, and when looking at that, this company has been able to achieve more spin-outs from Oxford University in the last 5 years than were made possible in the 700 years since the founding of the university. So it really does give an indication of just how much potential there is. That potential has always been in the university. It's just the commercialization of it was not always possible. And then as those OSI children come online and they grow, and external investors come in and IPOs take place, the value of OSI shares grows alongside that. So it's a prospect that we're very excited about. Looking at the investment opportunity set, so the OSI children, it spans across medical and health, which is 2/3 of the portfolio, digital tech and computation, chemical and industrial, and then energy, transportation, and defense. And there are a lot of companies listed here. Obviously, we don't have time to go into all of them. The point that I would like to highlight is that these companies represent groundbreakers in their field. They are involved in technology and research that is challenging the way we've understood how things work and the way in how things can work. They are disruptors in their space. And to try and give a bit of an indication of that, we've put some case studies together. One can see the OSI shareholding in these children. We think these are superheroes in themselves. Just to go through a few, there's Vasitech. So Vasitech develops products to treat and prevent diseases and cancers. They are also involved in vaccines, viral vector vaccines, which are very good at treating recalcitrant illnesses. And they're also involved in COVID-19 vaccine trials, which we're quite excited about. They've received government grant funding from the UK. And then moving from there to Evox. Evox has modified exosomes. So exosomes are natural secretions from human cells. And the way that Evox has been able to modify these is to actually use exosomes to deliver drugs to target organs in order to treat diseases. It's using the body's natural capabilities, so non-invasive, to treat illnesses, and it's something we're very excited about. They have recently entered a strategic partnership with the largest pharmaceutical company in Asia, where they are looking to invest close to $1 billion into this company. So again, something we're very excited about. Looking at Ultromics. Ultromics is involved in the diagnosis of coronary artery disease. And this was a scary statistic for me because I was not aware of this, but coronary artery disease is misdiagnosed 20% of the time. And when one considers how severe and prevalent that is in society, in terms of people having to deal with coronary artery disease, 20% is a very high statistic. What Ultromics has been able to do is to actually cut that error rate by more than 50%. And then moving from there to ONI, or Oxford Nano Imaging, they have created the world's most powerful microscope. So their nearest competitor is a company that is about 9 years old. It's worth about $8 billion. And ONI's microscope is more powerful than that company's, and it's produced at a fraction of the cost. So again, something very exciting. And then from there, moving to Osler. Osler is creating a portable diagnostic device. And that, the vision there is to be able to implement the testing of anything, anytime, anywhere, in terms of illnesses, through a single drop of blood, which will highlight biomarkers. And it's a vision that we believe Osler is going to be able to achieve. And again, with just where we are in the world, we think that it offers a lot of potential. So when I started with talking about the Sygnia OSI Fund, I mentioned that changing lives and making the unaffordable and the unachievable possible. And that becomes quite clear when looking at these children and spending a bit of time with them. So why invest in the Sygnia OSI Fund? I've mentioned the medical and healthcare sector and the benefit that we believe is going to be there in upcoming years. There's also R&D spend that comes out of Oxford University itself that the OSI children benefit from. And I've mentioned the commercialization of the IP. Something that I haven't gone through is that the commercialization of IP from universities is something that was very prevalent in the States. It's a saturated market in the States. So it is something that they managed to get right there, and they did it, but it has become a very saturated market. Whereas in the UK, they have actually lagged that journey. So they have started with it recently, and given where we are and the inflection point at this moment, we think it's an opportune time to invest. And then I've mentioned the OSI children, and we've spent a bit of time on those, and we think that they offer wonderful opportunities for investors going forward. The thing to note is that those children are ready to grow when they are ready to grow, and with that it means that we can only deploy capital into those children when they can come online. Given that, and that we do believe this is a superhero fund, we've seen a lot of investor appetite for it. Our investors love this fund, and we're happy because we love it too. So there has been a lot of investor money coming in, and what that means is we occasionally have to close this fund. We are going to be closing it temporarily. So for investors that do not yet have access to it, please do not despair. We are going to be opening it back up when capital can be deployed into those children. They are there, they are going to be coming online. It is just a question of timing. So I hope that I have been able to give you some insight into the Sygnia OSI Fund, and thank you for your time this morning. I'm going to be handing over to my colleague, Stephen Empedocles, and he will be talking about the Sygnia Enhanced Bond Fund.
Thank you, Tanya, and good morning all. Today I'm going to talk about the Sygnia Enhanced Bond Fund. The Sygnia Enhanced Bond Fund is an actively managed bond fund with the aim to outperform the All Bond Index. The fund is only actively managed in the fact that they purchase additional credit bonds, but do not take any active bets on interest rate movements. Taking a bet on interest rate movements is a very difficult thing to do, where active managers struggle at the task. And not by taking any interest rate bets allows the fund to have a similar risk and return profile to that of the index. Since the start of the year, South Africa went through a perfect storm, where due to the COVID-19 crisis and the economy going into lockdown, since then all the rating agencies has now downgraded South Africa to junk status, and this is because of weak economic growth and a rising debt burden. Now, talking towards harnessing yield and volatility in your portfolio, the Sygnia Enhanced Bond Fund is perfectly positioned into providing additional returns in your portfolio with a current interest yield of 10.5%. If you're uncomfortable with the extra credit, we also have the Sygnia All Bond Index Fund, which purely tracks the All Bond Index and currently provides an interest yield of 9.7%. Since the start of the year, South Africa has gone through 5 rate cuts, taking the repo rate from 6.5% to 3.5%, thus drastically reducing the income that can be found by investing in money market and enhanced income funds. The Enhanced Bond Fund and its benchmark invest in fixed rate bonds, where more than half of the fund's weight is allocated to investing with maturities of more than 12 months. So how does the fund perform? The fund is in the CISA category interest-bearing variable term, and over its first full year's worth of performance, it ranked 8 out of 32 unit trusts in its class. The 8 class slightly outperformed the Orbi index on a net of fee basis, while staying true to its investment objective of not taking any interest rate bets. We're incredibly proud of the performance of the fund and a well addition to our arsenal. The 10-year government bond yield can be broken down into elements and be displayed over time, as you can see on the graph. Starting with the 10-year yield of a US bond, adding inflation risk premium, exchange rate risk premium, and default risk premium, you can see that over the period, the default risk premium of South Africa government bonds has exploded over the period, speaking towards the weak economic outlook, persistent physical concerns, and the lack of confidence in the government to turn this around. The current 10-year government bond yield is currently trading at 9%, and if you take into account inflation of 3%, provides a real return for investors of 6%. At these levels, ranking South Africa top globally for providing real returns on their 10-year government bonds, only followed by Brazil and Indonesia, speaking towards the value of that can be captured by investing into government bonds. South African investors also have seen the value that can be found and has become the top investors in South African government bonds. In the previous slide, we saw the value in government bonds, but there's additional yield that can be achieved by investing in credit bonds. The Sygnia Enhanced Bond Fund achieved this outperformance by investing majority in government guaranteed SOEs, banks, financials, and telecommunications, totaling 53% of the portfolio. This is compared to a 7% allocation to SOEs in the Orbi. Since the start of the year, the most notable change is non-government guaranteed SOEs, which has exploded and speaks towards the risk of default has become extremely more prevalent. One of the good performing assets is government guaranteed SOEs, where the spread contracted compared to the government bonds in the search for yield. Another notable change is the contraction in senior bank fixed rate bonds, which has come down significantly with all the rate cuts over the period. So as Ian indicated, the only thing that an investor can control is the management fee you pay. For the All Bond Index Fund and the Enhanced Bond Index Fund, both has an annual management fee of only 35 basis points excluding that. This is one of the cheapest investments in its CISA category based on its TERS. Once again, speaking to active managers that charge more but still struggle to outperform or outperform on a consistent basis. And in summary, until business confidence does return, returns in equities will be muted, leaving the Sygnia Enhanced Bond Fund perfectly positioned for investment opportunity and a valuable part of our core satellite investment approach. With the interest rate cuts and the steepening of the yield curve, yields can be replaced by switching cash into bonds, but placing capital at risk. Sygnia Enhanced Bond Fund provides a low-cost opportunity in harnessing the yield in a low-return environment. I will now be handing over to Wessel Brandt, who will be speaking to us about the Berkshire Hathaway Fund. Thank you very much.
Good morning, and thank you for that, Stephen. I'll be sharing today with you one of my biggest passions at Sygnia, and that is working on the Sygnia Life Berkshire Hathaway Fund. I've been a long time fan and admirer of both Berkshire Hathaway and Warren Buffett. And when Sygnia started thinking of launching the Berkshire Hathaway Fund, I was very keen to join the act and support the view. This fund makes it easy and convenient for South African investors to access one of the biggest brand names in global investments, being Berkshire Hathaway, at very reasonable costs, and also saving investors the effort and scary thought of extremely expensive brokerage accounts, custody fees, and also forex costs. Over the last 54 years, Warren Buffett has managed this company extremely well, increasing the market value per share annually by 20.3%, and that compares to the 10% which the S&P 500 has reached, and that includes dividends. Warren Buffett recently turned 90 years of age, and what makes this even more spectacular is this now marks his 80th year in the investment industry, as he started at the tender age of 11 years old. Below is also a picture of longtime friend Bill Gates that actually baked him a cake for his birthday. Berkshire Hathaway has a listed equity portfolio valued at over $234 billion. This includes significant stakes in over 40 well-known companies. On the top of that list is Apple at $113.9 billion currently valued, and this is also 21.9% of Berkshire's current market cap. Other investments in the top 5 include Bank of America, Coca-Cola Company, American Express, and Kraft Heinz. But I would also like to pull your focus on the cash on hand and US Treasuries, which currently comes in at $147 billion. This equates to 28.2% of Berkshire's current market cap, which gives investors a lot of safety and confidence in the company and the management of it. Berkshire Hathaway has performed slightly behind that of the S&P 500 over the last 5 years, but this bodes well for an entry point at present, which is also evident in Buffett's active share buybacks on the market. Market commentators have been very negative on Berkshire Hathaway and the investments and also hoarding of cash. I tend to disagree with this, as I feel Berkshire Hathaway has been active in 2020 so far, actually allocating cash where they see opportunities in the market. Berkshire has spent $9.7 billion on acquiring Dominion Energy Transmission, which included a $4 billion in cash and then assuming $5.7 billion of debt from Dominion's books. With this acquisition, Berkshire grew its existing energy business with over 7,700 miles of natural gas and transmission pipelines, as well as 900 billion cubic feet of gas storage. Berkshire now provides energy services to more than 12 million electric and natural gas customers around the world. Berkshire has also invested 20.9 million shares in Barrick Gold for a total of $565 million. With Berkshire initiating its investment into the gold miner, some analysts are suspecting the opening of a bet against the US dollar. Buffett has always been of the opinion that gold is not an income-producing asset, so investors in gold are simply speculating that someone will pay more for the commodity in the future. Therefore, this move probably was done by either Todd Combs or Ted Weschler, Buffett's so-called investment deputies. Berkshire has invested into the top 5 trading companies in Japan, and the total value of these investments came to $6.7 billion, acquiring roughly 5% in each of these companies. Buffett has come forward and said that he won't increase these stakes to more than 9.9% of these companies without contacting management beforehand. This adds to the speculation that Berkshire is looking to hedge away more of its assets from the US dollar on expected weakness. These companies play a vital role in Japan's economy through energy, technology, and also manufacturing. Berkshire has not been all that bullish on the banking stocks in the US. In the last quarter, they reduced their stakes in JP Morgan Chase by 2/3, in Wells Fargo by 1/3, and then also completely exited their stake in Goldman Sachs. But Berkshire has been a very aggressive investor into Bank of America. In the last quarter, they increased their stake to 11.8% of the company by buying an additional $1.7 billion worth of investments. Bank of America is the US second largest bank by assets. It has a very strong capital position and a safe and consistent dividend history. I'll briefly take you through some of the financial results that came out recently. Berkshire reported earnings in Q2 of $26.4 billion, a significant improvement from the $49.7 billion loss made in Q1. Warren has stated on various occasions that including market movements of underlying investments skews results and is not a fair representation of what the business actually accomplished over the period. The pandemic's effects on manufacturing, service, and retail has been severe, reducing earnings to $1.45 billion from $2.49 billion. And then on my final slide, I really want to put some focus on the active share buybacks Berkshire is currently doing. In 2020 alone, they bought back $8.7 billion worth of shares on the market. And in Q4 of 2019, they bought an additional $2.2 billion. This comes to roughly 2% of Berkshire's listed equities. And what makes this more significant to investors is Buffett sees this as the best way to return capital to investors rather than paying out dividends, because he feels this is more tax efficient for investors. Buffett has done phenomenally for this company, and with the help of Charlie Munger and some other very unique players. But he is also of a strong opinion that passive investments is actually the way to go. And I will leave a quote with you from one of his earlier comments on his mentor, Ben Graham. A low-cost fund is the most sensible equity investment for the great majority of investors. My mentor, Ben Graham, took this position many years ago, and everything I've seen since convinces me of it. I've been a long-time investor in Berkshire Hathaway, and with Sygnia now making this so cost efficient and easily accessible to investors, I definitely will be an investor for a long time to come. I thank you for your time, and I'll now be handing over to Anton, who will be discussing the Sygnia FAANG Plus equity fund with you.
Thank you for that, Vishal. My name is Anton Swanepoel. I'm a portfolio manager at Sygnia, and as Vishal mentioned, I'm going to speak to you about our Sygnia FAANG Plus equity fund today. So, the world as we know it is changing. 15 years ago, the biggest companies in the world were dominated mostly by the oil and the energy industry. Today, 7 out of the 8 biggest companies in the world are all technology companies. The global economic landscape is shifting, moving away from the traditional brick and mortar model into the online marketplace. COVID-19 this year has rapidly accelerated this change, and Zoom, the platform that we're currently using for this webinar, is a great example of this. Technology has also been at the forefront of the market recovery since the crash earlier this year. So what is FAANG? FAANG is an acronym that was coined in early 2013, and it describes some of the most prominent companies in the technology sector today. These include Facebook, Apple, Amazon, Netflix, and Google, or rather their parent company, Alphabet. If you look at the performance of these stocks since the beginning of the year in dollar terms, Netflix has grown 62%, Alphabet has grown 22.4%, Facebook is up 43.7%, Amazon up at a staggering 84.2%, and Apple has grown 71.3%. This compared to the popular equity benchmark in the US, the S&P 500, that was up only 8.3%. So looking at our structure of our portfolio, what does the portfolio or the fund hold? Well, 20% of the fund is made up of our Sygnia Fourth Industrial Global Equity Fund, which Eva spoke about earlier, and the remaining 80% is made up of our FAANG Plus stocks. So in addition to the 5 which I already mentioned, we also have Alibaba, which is the biggest e-commerce company in China, Twitter, which you're all familiar with, and Baidu, which is the biggest search engine in China. Each one of these companies are at the forefront of transforming society and innovating technology. Just looking very briefly at the companies themselves, Facebook, we all know Facebook, on average 1.79 billion people log into Facebook every single day. Every month, 3.14 billion users log on to their family of apps. This includes Facebook, Instagram, Messenger, and WhatsApp. Facebook's worldwide average revenue per user is about $7.05, and Facebook is currently the 3rd most visited website in the world, outranked only by Google and YouTube. If you cast your eyes to the chart here on the right, you'll see that 98.5% of Facebook's revenue is made up from advertising. Apple, another household name. Apple's third quarter 2020 results came in much better than expected, their revenue being up 11% from a year ago, and their earnings per share is also being up 18%. They've also recently had a 4-for-1 stock split, which makes the stock much more accessible to a broader base of investors. And we're also expecting to see some exciting new launches from them in the remainder of the year, including possibly the iPhone 12, the Apple Watch 6, and some other interesting upgrades. Looking at Amazon, a very interesting statistic here is in the second quarter of this year, more than $1 that was spent in every $5 was spent online. This is the highest e-commerce penetration of any quarter or year on record. Amazon is currently bigger than the next 9 biggest US public retailers combined. US e-commerce sales grew 44.4% in the second quarter of this year, and online grocery sales has tripled over the last year. They've also now very interestingly announced that they're moving into the e-pharmacy space. This next graph just graphically depicts the size of Amazon in terms of market cap, just comparing them to the 9 biggest other public retailers that I mentioned earlier. As you can see, the market cap of Amazon currently sitting at around $1.73 trillion, absolutely dwarfs all of the other retailers combined. Netflix, roughly 45.4 billion minutes are streamed on Netflix every single week. They've once again added more subscribers this quarter than expected, and the existing member retention is also much higher than anticipated. In the US alone, 60 million adults have a Netflix subscription. If you look at the graph here on the right, it shows the regional breakdown of their subscribers. You'll see that the US and Canada make up 43% of the subscribers, Asia Pacific makes up 9%, Latin America makes up a surprising 18%, and the rest of the world combined 30%. Alphabet, known mostly for its 2 big names, Google and YouTube, the company, however, is made up of more than 200 smaller companies. Google itself now has 87.4% market share in the global search market, and every year more than 2 trillion Google searches are made. Gmail, the email service, there are about 1.5 billion active Gmail users in the world, and Gmail accounts for 27% of new emails opened around the world. Looking at YouTube, the media service, over 1 billion videos are viewed on YouTube every single day, and Chrome, the web browser, accounts for 63% or 63.7% of the market share of all web browsers around the world. So what about our plus stocks? The other 3 that I mentioned that are not included in an acronym: Twitter, Alibaba, and Baidu. We all know Twitter, 330 million active users every month on Twitter. Of those, 145 million use Twitter every single day. There are about 1.3 billion Twitter accounts in the world at the moment, and 22% of all Americans are on Twitter. Alibaba is the Chinese equivalent of Amazon. They are the largest e-commerce company in China by far. And in the second quarter of this year alone, more than 742 million people bought items on their platform. Alibaba accounts for 58% of all online retail sales in China. And then finally, just looking at Baidu, they're one of the largest AI and internet companies in the world. They are the biggest search engine in China and own about 69% of the market share. So let's look at performance. Performance for the fund over the last 12 months. This is up until the 31st of August in Rand terms. The Sygnia FAANG Plus equity fund grew 80.7%, meaning that if you had invested 10,000 Rand 12 months ago, it would have been more than 18,000 Rand now, including fees. Where the S&P 500 in Rand terms grew 38.8%, and the SWIX, which is the South African JSE shareholder weighted index, a proxy for shares in South Africa, went down 0.2% over the last 12 months. It is important to note on this slide, though, that the Sygnia FAANG Plus equity fund is a high risk fund, meaning that over the short term, it can exhibit some volatility. So why should you invest? Well, the Sygnia FAANG Plus equity fund gives you some great offshore exposure to some of the biggest and most innovative companies in the world, in one of the fastest growing industries in the world. And each one of these companies are at the forefront of transforming society. And that concludes my presentation, ladies and gentlemen. I'd now like to hand over to Monique Davidson, who's going to speak about our exciting new Sygnia Health Innovation Global Equity Fund. Thank you very much.
Thank you, Anton. Good morning, everyone. This morning I'm going to be speaking about the Sygnia Health Innovation Global Equity Fund. This is one of the newest funds in our stable. It was launched just last month. And as the name suggests, it's a fund very much focused on the healthcare sector. So a few things to mention about the sector before we dive into the fund itself. So firstly, it's a sector with some of the biggest companies in the world. If you just look at the top 5 pharma stocks, their market capitalizations are larger than all companies on the JSE, so just massive scale. And then it's a sector with quite high profit margins compared to other sectors, a large amount of R&D expenditure in the space as well, and a demand that has been increasing as populations continue to age. And we expect that to increase in the future as life expectancies continue to extend. Then just looking at demand, so this graph shows health expenditure as a percentage of GDP across developed countries. And that figure for the United States has roughly doubled since the 1980s. They're close to 1/5 of their GDP being spent on healthcare goods and services. Other developed nations kind of clustering around 10% of GDP. Then, of course, I mentioned it's a sector with a lot of R&D expenditure, and of course, associated with that is a lot of innovations. So some new innovations to get excited about include sort of the use of 3D printing in health sciences. So we're now able to print tissue and organoids for surgery, as well as highly customized prosthetic devices. Virtual reality is also being used to train medical practitioners. We're seeing the use of AI in diagnostics, immunotherapies and cancer treatment, and many, many others. Then just looking at returns from the sector. So this graph shows the MSCI World Healthcare Index compared to the MSCI World, the healthcare index being in the blue there. And as you can see, over the last decade or so, the healthcare sector has started to significantly outperform its parent index. Then just some reasons to consider a healthcare-focused investment for your particular strategy. So the first reason is that it's a sector that we don't have a lot of exposure to in the domestic South African market. So it's a great way to get some of that exposure. Secondly, the timing has never been better. We're seeing a lot of focus in the sector currently. There's a lot of government funding going into the space with non-dilutive grant funding, obviously great from a shareholder perspective. Apologies. Yeah, and then there is an investment with a long-term time horizon. There is a lot of R&D, capital and time-consuming research, which protects competition to some extent. And then fourthly, it's also an investment into the future of humankind. So the UN Sustainable Development Goals speak specifically about provision of healthcare and access to healthcare. And by investing in this sector, you're also aligning your portfolio to these goals for 2030. Then lastly, as we saw in the previous slide, performance has been great, and investors are flocking to the sector. So with that in mind, I'd like to introduce you to the Sygnia Health Innovation Global Equity Fund. So the objective of this fund is to harness some of the opportunities I mentioned in the previous slide. It aims to generate great performance as well as a positive impact on society. And the way we go about doing that is we have a core holding of 150 listed global equity stocks in the healthcare sector. These shares trade and are domiciled on developed market exchanges, and we also take a look at their environmental, social, and governance practices and make sure that they meet our minimum requirements for inclusion in the fund. Then the fund also has the opportunity to expand its investments into groundbreaking research and up-and-coming developments in the healthcare sector. This includes some of those exciting innovations I mentioned a bit earlier in the fields of genetic engineering, robotics, 3D printing, etc. And the way that we do this is through an investment into the Oxford Sciences Innovation Company. So this is the exciting investment that my colleague Tanya spoke about a bit earlier. But just to recap, it's a company that enables spin-out businesses from the University of Oxford. And as the University of Oxford is a world leader in medical sciences, naturally a lot of those spin-outs are in the fields of health and life sciences. So we get exposure to emerging technologies through that route. But that's not to say that the listed companies, that there's no innovation or exciting things happening there. I think 2020 has shown us that these companies are very innovative. There's a lot of research going on, and they've had to pivot very quickly this year in particular into developing products to address the novel coronavirus. And if we take a look at those stocks, so they make up about 97% of the Sygnia fund, and about half of them are involved in some shape or form in addressing the COVID-19 pandemic, whether it's with trialing a vaccine or a treatment or testing and equipment for testing, etc. And just taking a little look at some of the companies that the fund holds. So the first one being Johnson & Johnson, a very large, so the largest actually pharma company, very well known for its baby product range, but very involved in the pharmaceutical space as well. They are developing a vaccine for COVID-19. Then AstraZeneca, maybe a lesser known company, but has been in the news quite often recently as it formed a deal with Oxford to manufacture a COVID-19 vaccine. Then the fund also holds a company called Roche Holdings, a Swiss multinational company, the second largest in the world. It's very well known for its diagnostic abilities and pharmaceuticals range. It's also a leader in cancer drug development. Then the fund also invests in Pfizer Incorporated, again, another US multinational. They are currently testing 4 different corona vaccines at the moment with alongside German company BioNTech. And then lastly, the fund also invests in Moderna. This company is a bit smaller than the others, but it was the largest biotech IPO in history at the time of listing in 2018. And they use this messenger RNA technology for treatments and vaccines, and are currently also using this for the development of a potential COVID-19 vaccine. So I hope that that gives you a bit of a flavor of why the healthcare sector is so exciting at the moment, and a bit of a flavor of what the Sygnia Health Innovation Global Equity Fund looks like. And that's all from me. I'm going to hand over now to Ian Anderson, who will conclude the webinar for us. Thank you very much.
All right, well, thank you very much, Nikki, for that. I'm just going to stop sharing. And thank you very much, everybody, for listening to us this morning. I know that was a tremendous amount to take in, so thank you for sticking through it all. But hopefully you found it interesting, and hopefully it gives you some sense of how we utilize these satellites within our portfolio construction, how it benefits our fund, but more importantly, how you as an individual, as a direct investor, or as an IFA for your clients can utilize these funds in your investment solutions. There has been a number of questions, but I think what we'll do, given the length, is that we will respond directly to you. So I'll have the underlying fund manager open up a dialogue with you. And with that in mind, we're going to leave the webinar live for a little bit longer if people do want to post those questions. So it's not going to end straight away. So you can type your questions in, and then we will come back to you directly on that. But thank you very much for listening. We hope you found it interesting. Good luck and stay safe, everyone.